Welcome to Real Estate and Taxes with Lakshay. I will be helping you minimize your taxes. So once again, for those of you who don't know, my name is Lakshay. We're back with our Tuesday session on how can I save taxes if my income is more than $50,000. Well, this tax season, a lot of people are making somewhere around $100,000 mark if you are a realtor. So I wanted to, share and do a whole encompassing video in order to see how can other people who are making less than 100,000 but more than 50,000 can also save on taxes. So this is again going to be a short video where we're going to be covering 3 to 4 strategies as to how you can save some taxes. So let's get started. In today's agenda, we're going to be talking about 4 new things. Number 1 is incorporating and how it can help you. Number 2 is buying an electric vehicle. Number 3 is deferring capital gains tax. And number 4 is related to using your corporate earnings within a corporation. So my assumption over here is that you are joining today because you already have an incorporation, you have a business. So I'm going to be using as a basic assumption in order to explain to you how you can go ahead and save on some more taxes. So first and foremost, if you are in Canada and you are a realtor, you have the ability to incorporate. Accountants, lawyers, doctors, we all had this opportunity from before. But most recently, the real estate agents and all of the realtors now have this opportunity to incorporate. When you incorporate, the basic idea is you want to defer paying taxes, which is pay lower taxes on first $500,000 of income. Most of the time, when you look at it, people are paying taxes based on their income slabs. So let's assume you earn $40,000, you pay a certain amount of tax, then you start earning $60,000, $90,000, $100,000. You pay more and more taxes when you are a sole proprietor, business owner, or a real estate agent. Why would you want to incorporate? It's because if you incorporate, you pay only 12.2% taxes on first $500,000 of income. Yes, you heard it right. It is not based on slabs. It is actually based on the first $500,000 of income. You'll only pay lower amount of taxes. Whereas if you are an agent who's getting checks under your personal name, you might be on the hook of 50% taxes at $220,000 of income. So taxes as a sole proprietor versus agent. Here, I just wanted to give you a good idea as to how it looks like. The first $43,000 as a sole proprietor agent, you'll be paying 20% taxes. And as you make around $100,000 mark, you're in the 37%, 33% mark, which is where most of the realtors are. And as you start to become high earners, you start paying 50% tax bracket. You start paying 53.53. Over here, if you are incorporated, on the other hand, you only need to pay the first 4.2% taxes on first $500,000 of income. So a great way to kind of save on some money and save on some taxes is to incorporate. Now let's look at an example where we are comparing a sole proprietor person who's earning $400,000 of income versus someone who is the same person under the PREC model. So under a sole proprietor model, under commission of $400,000 of income, you had some advertising, rent, and utilities. Well, total expenses of $55,000. So 400 minus 55, you're working out at $345,000 of net income. On this net income, if you're a sole proprietor agent, you are in the 53.53% tax bracket, which brings your grand total of tax liability to 184. So now nobody likes this number. How can we pay lower taxes? I suggest open a PREC. Under the PREC model, if you are the high income earner in your family, you have the same level of income and expenses as the sole proprietor, where you have advertising, rent, utilities, but you have the ability to pay yourself a salary. In this scenario, you didn't have the ability to pay taxes only on the $45,000 of personal salary. You had to pay taxes on the whole amount after your net income. But in the PREC model, you have the ability to pay yourself a small salary of $45,000. But if you need more money, you can also pay your salary to your wife and children who are lower income in your family. So 45 plus 35 can be taken out from your PREC as a lower tax bracket, and this brings your net income to a lower amount, which is $265, and on $265 your 12.2% tax is $52,000. Now you're wondering what happens to the income that you have taken out as your salary, which is $45,000 and $35,000. You have to pay taxes on the salary that you have withdrawn. On 45 and 35, you're going to be landing in between 20 to 24% taxes. So $10,000 of personal taxes, $7,000 of taxes would be for your wife. So 10 plus 7 plus 52 would technically be working out to your tax liability. Even after we add all of them up, you still have a tax savings with the PREC. So that is something that I wanted to highlight today, that with incorporation, you have the ability to pay yourself a small salary, maybe a dividend. If you have children over the age of 18, or if your spouse is not working, you can also pay them a dividend or a salary. And then from that, you get to enjoy a better style of living as well as save a lot of taxes. So concept number 2 is zero emission vehicles tax write-off. A lot of the realtors want to save taxes. Today's topic was also related to saving taxes. So here's a strategy where you can basically write off your vehicle within not just one over the time of by depreciating it over a year. You can write it off in 1 year. What do I mean by writing it off in 1 year? So let's assume I recently purchased a Mustang Mach-E, which is an electric vehicle. On that electric vehicle, usually what I would do is if the cost of the vehicle is $100,000, I would depreciate it in 10 years, $10,000 each year. Those $10,000, I'll claim it as an expense on my taxes. But if you buy an electric vehicle, the new clause says that you can write off up until $63,000 of cost of the vehicle in 1 year. Yes, you heard it right. This is a brand new program where it used to be $55,000 in 1 year, then it moved to $59,000, and now it's sitting at $63,000. You can basically, instead of depreciating your car year over year by in smaller installments, you can write it off $63,000 in one shot in 1 year. So something to think about, because it can significantly impact your tax bill. Whether you are incorporated or whether you are buying the vehicle under your personal self, in both scenarios, if the vehicle is being used for your business purposes, you get to write off the entire cost in one shot. So that is something that I wanted to highlight today, because it can significantly change your tax payable position to a tax refund position. So something to think about, and talk to your accountant or talk to me, book an appointment, and we can walk you through filing your taxes, as well as making sure that you get the right deductions possible on your taxes. A lot of the people, just for the purposes of this, bought Teslas, bought electric vehicle, because this write-off is significant and it can really bring you in a positive position. Let's move on to the third strategy in saving you taxes. A lot of the time, people are selling their houses and they want to defer the capital gains tax. And this is one of the most important questions that people are asking. Lakshay, how do I reduce my capital gains tax liability? The option is looking at vendor take-back mortgage. So let's assume me and Nitish ji are in a transaction where I bought the house that he had it on sale for $1 million. But at the time of closing, I was short of funds. What we can do is we can ask the seller to extend us a loan for the shortage of the amount. It might be $200,000, it might be $100,000. That is technically a vendor take-back mortgage. What are the benefits? The seller is able to, sell the house, and I, as a buyer, am able to buy the house. On the additional vendor that, vendor is giving as an additional mortgage to us, that additional amount is technically given to us on extra interest. So if I were to buy a house on a vendor take-back mortgage, I would technically, have to pay two portions of interest, one on the mortgage, one on the second mortgage that the seller is basically lending me on. So that is something to think about, because a lot of the people are in the scenario where the appraisals come short and now they're in a limbo that they're not able to finance the whole portion of the mortgage through the bank. They can go to their seller, either ask them to reduce the price, which they will most likely not do, or the second option is ask the seller to extend a vendor take-back loan. It basically is mostly popular in commercial investment properties. It is not popular in residential properties, but most recently appraisals were coming lower than the value of the house. A lot of the people started looking at the vendor take back as the option. So now that we understand what a vendor take-back mortgage is, which is technically just a second mortgage, second loan from the seller to the buyer, how can we use it to reduce our taxes? So in the scenario where someone is selling the house for, let's assume they had purchased the house for $700,000, they sold it for $500,000, their capital gain is $200,000. So in perfect case scenario, you would technically have to report the $200,000 of capital gain in your personal income. Let's assume your personal income for that year was zero. So your personal income becomes $200,000. Because 50% of it is taxable, $100,000 of it gets added to your income. If your income was zero that year, your income $0 plus the taxable capital gain, which is 50%, 0 plus $100,000, you'll be paying taxes on $100,000 of income for that year. Now you're wondering, I don't want to pay taxes on capital gains. How can I defer it? Because I don't have that big of money chunk sitting with me. What you can do is you can technically use the $200,000 and ask the buyer to buy it in portions. Let's assume me and the seller or me and the buyer have the seller and the buyer have a good relationship. They're related. Instead of paying in one shot, you can ask your new buyer to pay you in 5 years. In this scenario, $40,000 over 5 years. If they pay only $40,000 per year, you only have to realize capital gains of $40,000 per year. You don't have to realize the whole amount. This is the perfect idea where you are able to reduce your capital gains tax. By spreading out the capital gain, you'll be able to decrease your taxable income, and now you are in a lower tax bracket, meaning you'll pay lower taxes. Basic idea is, instead of recognizing the whole capital gain in 1 year, get into a vendor take back, ask the person who's buying from you to pay you the whole amount, but in stages over the span of, you go do it to a maximum of 5 years and spread out the capital gain. If you spread it out, you only have to realize capital gain in installments, and this way you get to pay lower taxes. In a particular year, if I add $100,000 to existing income, I'll be in 50% tax bracket. If I only recognize $40,000 in a particular year, that will probably not send me into the highest tax bracket, and this way I'm able to avoid or defer paying taxes. The second option is also related to buying and selling a house, where you have a capital gains, but in this scenario, you can get into a joint venture agreement. Let's assume you bought a property for $600,000. You invested $65,000 in renovation. By finding a tenant, you rented it out for $2,500 a month. Now, 3 months later, you find a new tenant and sell this property for $765,000. Well, technically, this will result in a capital gain of $765 minus $665, which is 600 plus 65. So it's $100,000 of basically your capital gain. How can you minimize this capital gains tax? In order to minimize this taxable capital gain, what you can do is when you're selling the property, you can create a joint venture agreement where you tell them that you still own 1 to 2%. In this scenario, I said 50%, but you don't need to be at this high number. You can be like, you still own 1 to 2% of this property when you're selling it, whether it be selling it to a related party, which is going to be your sibling, your friends, or your cousins. This can actually work in your favor, because when you own even a small percentage of the property when you're selling it, you technically have not disposed of any property. If I sell a property to someone and I still own a percentage of it, I don't have to record the capital gains in my current year, meaning I don't have any capital gains to report. That means zero tax liability. So joint venture agreement is definitely something to consider if you want to basically reduce your tax liability. Again, when you create a joint venture agreement and a bare trust agreement, you're not on title, you're not on mortgage, because in essence, you've sold it, but you still own a percentage of it. Number 4, and the final one that I want to discuss with you today, is how do you use corporate earnings to buy properties without paying marginal taxes? A lot of us are realtors, or a lot of us are business owners. When we have, let's assume, $300,000 of income, we have expenses of maybe $150,000, and the remaining $150,000 we pay taxes on. Once we pay taxes on that income, we have two options. We can either withdraw the money and pay a second layer of tax in the form of salary or dividend, or we can keep it inside the corporation. If we end up keeping our retained earnings, which is after we pay everyone, after our taxes, after everything, if we keep keeping 50,000, 100,000, whatever it might be for your scenario in the corporation, that continuously multiplies every year. Now you must be wondering, your corporation has significant amount of retained earnings, and you're trying to, pay lower taxes or pay no taxes, or you're trying to pull out the money. How do you pull out the money without paying taxes? How do you buy a property with your retained earnings? The solution is you get your corporation to buy that house. So in this scenario, let's assume I have a house and I have a retained earnings sitting in my corporation. Over the span of 3 to 4 to 5 years, I have $400,000 sitting in my corporation, which if I were to withdraw, I'll pay taxes. How can I use that money to, and basically use it towards my own self because I want to pull that out. What you can do is you can sell your house to your corporation. Because your primary residence, when you sell it, the taxation is zero. The principal residence exemption rule is zero. It means you can sell the house to your corporation at no tax liability and pull out the money from the corporation. But now the corporation will technically be the owner of the house. So this is a great way to use money from your corporation and withdraw it without paying any taxes. You sell the property, receive the money tax-free from your corporation, and you rebuy a new bigger home with this amount or with whatever you wanted to do with that money. Your capital gains is zero because it was your principal residence and you sold it, and basically on principal residence the capital gains tax is exempt. It will trigger although a land transfer tax fee, and if the corporation owns your house now, you need to pay them rent, and significantly, you can basically use the earnings in the corporation that was locked away that you had to pay taxes on otherwise. So something to think about, and it is a great way to use money that is stuck inside the corporation to buy a house. So that basically wraps up all 4 strategies that I wanted to share with you today. Number 1 was buying an electric vehicle. Number 2 was selling your house to your corporation, withdrawing the money tax-free. Number 3 was deferring capital gains by, vendor take back or through a different strategy, which is called joint venture agreement. And number 4, we discussed about how to basically incorporate and save money. So here's my contact information. If you're looking to, file your taxes, minimize your taxes, you can certainly reach out to me by email or phone number. I'll be more than happy to, schedule an in-person appointment or, do a Zoom call in order to file your taxes.